Hi guys, this is CA Anand Tirtha, your faculty for accounting. I welcome you all for this CA Intermediate Advanced Accounting Revision series. In different sessions, we'll be revising all the topics which is applicable from advanced accounting point of view. All the topics which are prescribed by ICI according to the new syllabus will be covered here. I hope that you have already completed your at least one time of studying and you are now attending this for revision purposes. All the sessions and videos which we will be discussing in the future will be mostly in consideration with the revision aspect. Full-fledged learning you might have already done, and I expect you to cover each and every topic from your studying point of view also and from the revision point of view as well. Let us try to make our previous day of the exam learning simple. So in the coming videos, we will be revising almost all the topics. At the same time, we will be revising with certain chart based mechanism so that it will be helpful for us to go through, it will be helpful for us to learn, and even it will be helpful for us to remember for a longer period of time. So whatever is discussed in these videos, I would suggest you to take a book and also make a note of all the charts, topics, summarizations, etc. so that you can use this book on the previous day and you can learn it and make it even better. If at all you feel these videos are helpful, suggest these to your friends as well, and do subscribe for my channel for any other videos and even other content. With this, let us start our first session on this Intermediate Advanced Accounting series. In the first session, we will be dealing with the cash flow statement, which is one of the most important topic. At the same time, it requires some learning from a student point of view. A lot of my students have asked as to how it can be summarized and how can we remember it better. So I have tried to convert this entire session into chart based learning so that it will become helpful for you and at the same time it becomes better for you to learn. So without further delay, let us start learning the very first topic, which is in connection with cash flow statement. As I have said, keep a book and pen with you so that you can learn this and make a note of all the things what we will be studying. Happy learning. Let us start with the first session. So let us take up in connection with cash flow statement. Very interesting topic. Reason being, if we have looked into the financial statements, we know that all the financials, all the books of accounts of a company should be maintained according to accrual system. But here we are learning about cash flow statement, which means the theory of this topic is actually very less because the standard is involved. We have to learn the rules and regulations of the standard, etc. But the more important part of this topic is how do you convert the accrual normal mechanism of a company into the cash mechanism for applying this in the cash flow statement. Okay, before we move on with those explanation and see what's happening, I'll just try to summarize whatever I wanted to tell with a very small example. Let's say that we have got credit sales. All right, so there is credit sales of, let's say, 500 rupees. There is opening debtors of 100 rupees. There is closing debtors of 200 rupees. Okay, this is a data which these two will be derived from ledger, and this will be there in the previous balance sheet. This will be there in the current balance sheet, and this will be there in P&L statement. So financial statement mainly, which contains balance sheet and statement of P&L, will contain these data, But whether this data can I directly apply in the cash flow statement, the answer is no. I need cash flow. We'll discuss in detail as to what is cash flow, how it works, etc. But as the words itself tell us that we need the cash flow related to it. So what should I do now? I can't write credit sale because there is no cash flow in credit sale. Opening and closing debtor are telling you opening receivable and closing receivable. But for cash flow, you need the received part of it. So what do? Imagine a debtor account. If you imagine debtors account, what happens? Opening debit balance, it will be there. So to opening, it will be 100. By closing will be 200. To credit sales will be 500, and therefore by cash will be the balancing figure, which is 400. So cash flow over here is 400, which means in P&L we write the actual income whether it is received or not, because we do on event basis accrual system. But in cash flow statement I need the actual cash coming in. So therefore, in this particular topic, for the people who feel this topic is confusing, for the people who feel it is difficult to approach, etc., the approach is very simple. The approach is the company is following accrual mechanism when they prepare the books of accounts. How do you convert that and bring cash towards it is what we try to implicate in cash flow statement. Okay, so in our normal, this is examination, correct? So in exam they will not give you simple situation of accrual and ask you to convert into cash. Now what they do, they give you adjustments. From adjustments you have to derive how normal accrual might happen. I'm not saying all the time, but this is the famous requirement which normally happens. From this normal accrual you should go with cash flow. So normally when you do financial statement, which is basically balance sheet and P&L, even cash flow is also a financial statement, but the general thing which we normally do is balance sheet and P&L. Now over there what happens, if there are adjustments, you directly see the implication on balance sheet or P&L or both, and you apply that and close it. But here what we need to do, adjustment will apply them first, then move a step ahead, and from that info try to derive the cash requirement. So that brings the trickiness to some extent, which I do agree. But ultimately, I believe that once we are done with learning this along with the revision part of it, I would say that it will be easy for you to derive cash flow out of it. So I will try my level best to make this topic an easy one, or conceptually let's get more stronger here. Now, we understood what is the requirement of this topic, where all the financial statements except this one will be created by the company on accrual mechanism, but the shareholder should also know that how that cash has been utilized during the year, because one of the major asset is cash and bank balance for the company, because that is the ultimate one. If you have fixed asset, you create inventory out of it, you sell them, you get debtors out of it, ultimately what you need back is cash. So how that cash opening to cash closing have rotated during the year is what we are trying to look here. So entire element is now explaining it to the user of the financial statement. So therefore guidelines have been prescribed for the same. So cash flow statement, basically then what can be considered then? Cash flow statement tells you about the cash flow. As the words itself say, looks silly, but it tells about the cash flow. Now what type of cash flow can happen? Either cash inflow can happen or cash outflow can happen, where in our normal words we call inflow as receipt, we call outflow as payment. But if the business is for a very long time, this receipt and payment is a daily activity. How will you decide, or how will you analyze the cash flow? For that purpose, it will be done between time frame. Usually the time frame will be 1 year. So let's say that we have got a financial year as 2021-22. At that time, starting from 1st April 21, ending on 31/3/22, within this period, how much cash flow has taken place. Cash flow means cash inflow or cash outflow. Okay. Now, what inflow and outflow of cash do we check between a time frame? We look into the flow of cash and we also look into the flow of cash equivalent. So guideline for us mentioned that you are not just supposed to look into the cash flow, but cash will include the cash equivalent as well. So now the very first question arose here. What do we mean by cash? What do we mean by cash equivalent? Let's start looking into the meanings first. Cash. The meaning of cash according to the rules and regulations provided to us is it will include cash in hand. This is number one. Second, demand deposits with bank. Okay, so the term cash includes two things. One is cash in hand, the other one is demand deposits with bank. Okay, demand deposit basically is business point of view we are talking about. So therefore, demand deposit is basically current account. In our normal mechanism, we call it as bank balance. Okay, so bank balance and cash both are included in the definition of cash itself. So what do we mean by cash equivalent then? What's the meaning of cash equivalent? Now, cash equivalent basically means they are short term. Second one, highly liquid investments. So they are short term, highly liquid investments where the fluctuation is negligible. So basically it means that any short term highly liquid investment. Now what do we mean by highly liquid investment? It is easily convertible into cash. Okay, let's take an example. I have got a bank FD. It's an investment. So I have got a bank FD. I have created an FD. I want to close it. I can directly call bank and ask them to close and put it back to my bank account. Yes, which means it is highly liquid. Whenever you want to close that investment, you are allowed to do it. Then the fluctuation in value should be negligible, which means if I invest in shares, the fluctuation is very high because within a week there can be a big gap between how much you invested and how much you have earned. Maybe it is profit, maybe it is loss, but there is fluctuation in value. So can I consider those equity shares to be called as cash equivalent? No. Why? Because there is volatility. So it should not be volatile. So bank FD, which I spoke about, is a very good example. I have invested in bank. I will be given certain rate of interest, but my principal value will never change. So therefore, it is supposed to be very negligible fluctuation or no fluctuation at all. And very important thing is, what do we mean by short term? From AS point of view, from cash flow statement point of view, that short term means 3 months or 90 days. So short term, 90 days, highly liquid investment, easily convertible into cash, fluctuation should be high, very negligible. So which examples can we take? A 90-day bank FD can be considered as example. Then all your RBI bonds, treasury, every bond related to government can be considered because it is risk free, there is no fluctuation in value. Suppose if preference shares and debentures have redemption period less than 3 months, because we know that if the company is directly redeeming the debenture or a share, preference share specifically, because equity share is always fluctuating, but if preference share and debenture is actually getting redeemed by the company, we know that the redemption will be done either at par or at premium, which means fluctuation in value is not there. So in those situations, you can call them as cash equivalent. Even cash equivalent is also a part of our cash flow analysis. which means from between opening and closing, how cash got fluctuated. For that analysis purpose, even cash equivalent is also a part of it. Okay, so basic idea of cash flow statement is what? I want to see the cash flow between opening and closing, which will lead to either inflow of cash or outflow of cash. Is it only cash? No, cash includes cash equivalent as well. Okay, so for preparation of this entire cash flow statement, our ICI came in and said, we will tell you, or we will give you the guidelines as to how the cash flow needs to be done. So the entire cash flow what we have, which is basically inflow and outflow of cash between a time frame, is now covered by AS3. Okay, part of financial statement, every company should do it, but if we remember, or if we have looked into the previous session video of ours, some companies need not prepare cash flow statement. For example, small company, private company being a startup. So for them, some benefits or some relaxation has been provided. They need not do it, but majority companies have to do cash flow statement. It's one of the integral part of the financial statement. So how do we do it? AS3 is the standard applicable, which gave us the guideline as to how the cash flow statement needs to be prepared. Now, according to AS3, they said divide the entire cash flow into 3 activities. Okay, so cash can come in, cash can go out, and cash can come in and go out not just in your day-to-day activity. Cash can come in and go out in one-time transactions as well. Example, cash will come in when I receive money from debtor. Cash will go out when I pay amount to the creditor. Cash will go out when I pay salary. All these things are recurring, which happens in day-to-day life. At the same time, I issue shares, I'll get money. One-time thing, but cash has been received. I will buy machinery. One-time thing, but cash has been paid. So cash coming in and going out is not just restricted to your day-to-day activity. It also comes in and goes out in one-time transaction situations as well. So for that reason, AS came in and said the entire cash flow what you are telling, so it's not just restricted to P&L now, it also contains balance sheet items. All these has to be divided into 3 activities called as operating activity, investing activity, and financing activity. So entire cash flow divided into 3 activities. Now what happens in operating activity? Operating activity contains principal activity. Okay, I'm not giving you all the sentences, I'm just picking up the important terms involved in the standard. So operating activity will include principal revenue generating activities, which means for the purpose for which you have created the business, whatever cash coming in and going out is happening, it comes under operating. So let's assume that the principal activity of our company is sale of software. If my principal activity is sale of software, then whatever cash coming in because of software is operating. Whatever cash is going out because of this software is operating. So cash going out because of software means I have to develop software, so I have to pay salary to my employee, that is also operating. They will sit and they will take benefits of all electricity, water, everything, that also operating then. At the same time, those people will have to be provided with some food, recreation activities, operating. So anything and everything related to your principal revenue generating activity will be considered under operating activity. Not just that, if anything cannot be included, in investing activity or financing activity, even that will also be considered under operating activity. So investing and financing, I am not able to decide whether it is investing or financing. It's difficult to prove that it is investing or financing, then put it to operating itself. So operating, we also call it as residuary section. For example, there might be forex changes, foreign exchange changes, which applies to cash or other assets and all. We'll directly apply it on operating itself, because it's very difficult to divide between investing and financing. Directly put it to operating. Okay, so operating mainly considers principal revenue generating, all connected items are also considered, and anything which cannot be directly included in investing and financing activity. Okay, so we know the example. So it can be sale, purchase, obviously cash sale and cash purchase, then debtor receipt, creditor receipt, salary paid, rent paid, etc. All these things can be considered under operating because it is our day-to-day activity. Next, investing activity. Now, investing activity refers to all cash flow related to long-term asset and investment. So, investing activity refers to all those activities, cash inflow and outflow, related to long-term asset and investment. What will happen with long-term asset? Either you will buy a long-term asset or you will sell. So long-term asset, stress on that word, not current asset. Current asset is short-term. No, we are only talking about long-term here. So long-term asset and investment. Suppose, let's say that you have got an asset where machinery is involved. So if you are buying machinery, then cash is going out. You are selling machinery, cash is coming in. So on that regard, what is considered here, all the cash flow will be considered to that extent. Also, second one, even income or expense generated through long-term assets and investment is also investing activity. Example, I have made a long-term investment, I earn interest out of it, even that is also investing activity. So interest on investment is investing activity, because why you got that interest? Because you made that investment. So all the connected items will also be considered in the same activity. Okay, I have purchased shares of another company. Great, you have made an investment, then investing activity. From that company I received dividend, even that will also become investing activity. Now both of them are received here. Okay, because we are the investors, we will be receiving here. Okay, so all the connected items are also considered in the same activity itself. Third and the last one, what is considered under financing activity? So first one, it is related to owner and borrower fund. Any cash flow related to owner and borrower fund, we call them as financing activity. Example, I issue shares, my owner fund increased, cash is involved. If cash is involved, then financing activity. I had debentures, I am redeeming it, which means borrower fund is getting reduced, financing activity. Not just that, same like investing activity, even income or expense generated out of it is also financing activity. Example, I have got debenture. If there is debenture, I pay interest on debenture. So interest on debenture, why are you paying? Because I have issued debenture. Debenture is financing activity, so interest on debenture is also financing activity. I have got equity and preference shares. Because I have got equity and preference shares, I pay dividend. Now why did you pay dividend? Because I have got shares. What are shares? Financing activity, which means dividend paid is also financing activity. So interest on debenture paid, dividend paid. Received will be investing, paid will be financing. Okay, so that is how you have to first understand how the division of activities have taken place. So operating is principal revenue generation. Majority of your cash flow will be in operating itself, because as we have already discussed, this investing and financing most of the time are one-time transactions. It will not happen like 50-60 times in a year. But receipt from debtor, sale, purchase, payment of expense, all these things are almost like every month. Anyhow it will be there. It might get repeated in every 4-5 days as well. So therefore, majority of your activity will go in operating itself. However, we should also know about investing and financing as well. So adding up all these three activities together will give you overall cash flow of the company. So the first thing what we got to remember is, for you to make these bifurcation, cash flow is important. What if there is a situation where there is no cash flow? It will not even be considered for AS3 purposes. I'll give you an example. I have issued share. It is financing activity, okay. But I have issued share to take another company's shares. If you are finding it confused, I'll talk about investing now. I purchased machinery, investing activity, but I purchased machinery by issuing shares of my company. At that time, the journal entry is machinery account debit to share capital account. I'm not paying any cash here. I'm issuing shares to get machinery. Is there any cash flow? No, it will not even come in the cash flow statement. So for anything to come in cash flow statement, three activities bifurcation is yes. But that three activity bifurcation is of the cash flow. If there is a non-cash item, it will not be a part of cash flow statement. Okay, so that is how the analysis of cash flow needs to be done. Then, now we know that AS gave us a rule where it said that divide all of them into activities, which we did. Now, what about preparation of that particular cash flow statement? How do we prepare it? Because we know that whatever cash flow has come in has got bifurcated into three activities. But how do we prepare cash flow statement? Again, for that there is guidelines given for us. For operating activity, investing activity, financing activity. For operating activity, since I have told you that there are many items involved, institute, while they prescribed AS3, they have given us two choices to adopt. Either I can do it according to direct method, or I can do it according to indirect method. For investing activity and financing activity, there are no choices. Both of them will be done under direct method. Okay, so to prepare the three activities to see how much cash flow has taken place, operating, since the numbers are more, two choices, either direct method or indirect method. But investing and financing activity, since they are most of the time they are one-time elements, only direct method is considered. Now, just to get an idea, what is direct method and what is indirect method? I need cash flow from direct method, which means simple stuff. When you started your day, in your wallet you have 500 rupees. You took 100 rupees from parents, 200 rupees from friends, etc. You started spending that cash also. Ultimately you got closing cash. So in direct method, what happens? How much is received, we will consider the total. How much we paid, we consider the total. The difference is net cash flow, isn't it? So therefore, in direct method, how do we disclose? How do we present our answer? We say that it is cash receipt less cash payment. But needless to say, related to operating activity. Related to operations, how much is cash received, how much is cash paid. So in the same way, even for investing and financing also, we do the same thing. We show all the cash received as positive, we show all the cash paid as negative. The difference will be the net cash flow. But what happens when we are supposed to follow indirect method? In indirect method, instead of picking each and every item, if we remember our previous video, even when it comes to managerial remuneration, when we calculated profit for the purpose of managerial, over there also direct and indirect method was there. What we did in direct method, we picked whatever items are needed, we picked. Indirect method, we don't do that. What we do, we already have an end answer called as profit. For that, we make all the changes required for our purposes. So even in indirect method also, the same thing is done. Profit base is available with us. But we know that profit is going to contain accrual mechanism, and profit will contain all activities. Okay, try to understand this very carefully. Once you get this logic correct, then whatever cash flow you might have done, whatever problems you find that is difficult to understand, everything will become easier because now you know the underlying logic. Profit contains accrual mechanism. Why am I specifying accrual? Because if there is accrual, there can be cash items also, non-cash items also. So it is done under accrual mechanism. Then it may contain all activities. Example, we decided that interest on investment is financing activity. We decided that interest on investment is investing activity. Interest paid on debenture is financing activity, isn't it? Now, interest on investment is other income shown in statement of P&L. Interest on debenture paid is shown as finance cost in P&L, which means P&L will contain all activities also. P&L will contain accrual mechanism. Now, what we do, we will make sure that we adjust the profit in such a way that we get two things there. One, cash, and second, operating activity cash. Okay, so from accrual, which contains both cash and non-cash item, we remove non-cash. We adjust it and we remove non-cash. Only cash remains. Okay, in this cash also there might be all three activities. Remove the other two activities, only operating will remain. This will give you operating activity cash flow. Okay, so that is how we do it in indirect method. So in indirect method, profit will be the base. From that profit, which contains accrual contains both cash and non-cash item, we remove non-cash, only cash will remain. From this same profit will also contain all three activity, we remove the other two activity, we'll get only operating. Ultimately, we have only operating cash item, that itself is required. So every time when you solve the problems, especially when it comes to indirect method, where you don't have a choice to pick whatever you need, at that time underlying logic of the entire solution will be this, where you have a profit base, that profit base contains all items, you remove all those items which are not required. Which are those not required items? Non-cash, non-operating, which ultimately leads to your final operating activity elements. Okay, so this is how we present our cash flow to the shareholders. So we first prepare the operating cash flow, continued with investing cash flow, continued with financing cash flow, isn't it? Just quickly remember whatever you have studied. We first give operating activity cash flow, then we give investing activity cash flow, where operating can be done under both direct and indirect method, investing only direct method, financing only direct method. We take the total of the same, we get net increase or decrease in cash and cash equivalent for the year. For this, we add opening cash and cash equivalent. Finally, we get closing cash and cash equivalent. If the detail is available, this closing cash should tally with balance sheet cash and cash equivalent. Okay, so we have already done problems. It is basically revision for the same, but this is the structure we have created for cash flow statements now. Okay, so with this background understanding of cash flow mechanism, as I have told you, explanation is actually this much itself, because it's only about how do you get the cash flow, how do you apply the cash flow, etc. With this learning, the later any problems created by the institute, we can apply our basic logical understanding and get suitable answers out of it. Okay, now I'll slightly move a bit further, and for that operating activity, let's quickly remember what format we followed under both direct method and indirect method. So for direct method, what is the mechanism we followed for the same? So for direct method, the entire structure went on with receipt minus payment, correct? So therefore first we talk about receipts. This is the format for the same. Okay, so first we spoke about receipts. Receipt might contain cash sale. Credit sale cannot come here because there is no cash flow in credit sale, but receipt from debtor, there is cash flow. Then other operating income which we receive. So these are our receipts. Then we deduct payments from it. What might be the possible payments? Cash purchases. Second, payment to creditors. Third, payment of operating expenses. Not investing and financing. So shall we consider interest on investment in other operating income? No, because it is investing income. It's not operating, so exclude. Shall we include interest on debenture or dividend paid in payment of operating expense? No, because they are financing. So what do we need to do? We will only be including operating payments. Example, salary is there, rent is there, carriage is there, etc., etc. Okay, so all those things will come here. Now once you do receipt minus payment, the next thing what we do is we deduct income tax paid. We'll discuss some points about income tax, but income tax paid needs to be deducted. Once you deduct it, you will get cash from operating activity before extraordinary item. For this, make adjustment which is plus or minus extraordinary item. And ultimately what you get is cash from operating activity. Okay, so this is the general requirement which we follow in direct method. So direct method, receipt minus payment. For the difference, then whatever income taxes are paid will get reduced, and ultimately if there are any extraordinary item, in the sense which does not occur in normal day-to-day life, so it doesn't occur in the normal course of business, those are extraordinary. If it is extraordinary, the rule is it cannot be included along with all the normal items. You have to explain it separately. So for that reason, extraordinary item will be written here. Example, we received insurance claim on loss of stock. Now even that is also extraordinary, but because it doesn't happen in day-to-day life. There is a suit which we have filed against another party, which means we have put a case against them. We won the case, we are receiving compensation, which means it's extraordinary. It doesn't happen in day-to-day life. Okay, so those things has to be shown separately. Cash flow has to be involved. It should be shown separately, and ultimately we get cash from operating activity. What is the format if we follow indirect method? Okay, what is the mechanism we have to follow when it comes to indirect method? So indirect method, different types of formats they follow. I will consider one comprehensive format over here. Suppose if we have profit transferred to balance sheet, which is basically current year profit transferred to balance sheet. For this, we will add back all the appropriations, because in appropriations there is no cash flow. Example, of the total profit earned, we transferred some 1 lakh to general reserve. At that time what happens? Profit reduced by 1 lakh, GR increased by 1 lakh. I want to know what is the current year profit, because from current year profit you can bifurcate non-cash, cash, remove non-cash, etc. So for that reason, whatever appropriations are done, all appropriations are added back. Now once you add back all the appropriations, you will get profit after tax. But we know when it comes to taxes, most of the time, that whatever income we have earned in this year, the tax will be paid in the next year. So in this year, what do? We will create provision for tax. So therefore, that provision for tax is also added back. No cash flow in provision. Provision for tax, and ultimately what you get is profit before tax. Okay, Suppose, say for example, in any exceptional circumstances, the taxes are paid in this year only, provision is not created, directly the taxes are paid, at that time provision for tax will be 0. Okay, so provision for tax if created will be added back. Next, for this profit before tax we will add or less non-cash and non-operating items. Non-cash, for example, depreciation is there. After reducing depreciation only we get profit for the year, so depreciation is non-cash, we add back. Profit or loss on sale, there is no cash flow, again we make the changes accordingly. So all those things will be non-cash and non-operating changes. Once we do non-cash and non-operating changes, we will get operating profit before working capital changes. See, the thing is, profit is kept as base. From that profit we already decided that there will be non-cash items also, non-operating items also, which we have to remove, which we did. But cash is something which will not only reflect P&L, it will also reflect balance sheet. Correct? If you imagine the cash mechanism, cash will be there as a part of P&L because there are a lot of income and expense which will be done in cash. Cash will also impact balance sheet. Why? Because there will be cash flow in the balance sheet. Example, I buy asset, there is cash flow. I sell asset, there is cash flow. I pay liabilities, there is cash flow. So cash will happen in balance sheet also. Now balance sheet, I will divide it into 3. Okay, one is long term asset, short term asset, then liability wise I will say borrower liability. Short term asset and liability I will consider. Okay, which means in this entire balance sheet, if there is any cash flow in long term asset, it is investing. If there is any cash flow in borrower liability or owner liability, it is financing. But one thing is missing, we don't consider short term assets and liabilities there. Why do we don't consider short term asset and liability in investing and financing activity? Because short term asset and liability most of the time are utilized for day to day life. Example, there is inventory, day to day life. There is creditor, outstanding expenses, all of them are day to day. If anything is day to day, it is in operating activity. So this will apply for operating activity. That is working capital changes. Because working capital changes is basically the day to day activity of a business. So therefore, any assets and liabilities which are related to working capital is covered over here. Okay, so therefore long term borrower, both of them are now bifurcated between investing and financing. Short term related to working capital, nobody is touching it, therefore it's a part of operating activity. Okay, now we are talking about working capital changes, isn't it? So therefore, what is the possible working capital changes? There are 4 possible changes. One, increase in current asset. Second one, decrease in current asset. Third one, increase in current liability. Fourth one, decrease in current liability. 4 things are possible. Now, what are we supposed to check here? You need to check the impact on cash balance because of this. Because of this working capital change, what is the impact on the cash balance? Okay, now increase in current asset. If current asset increases, where point to be understood, these should not include cash, because we are analyzing cash, correct? I know that cash is also a current asset, but this entire statement is prepared to analyze how opening and closing cash have fluctuated during the year. So that will not be covered here. Other than cash, all assets are covered related to working capital. Okay, so therefore let's take an example as debtor. If what is the meaning of the term debtor? Amount receivable from people are debtors. So if debtors are increasing, receivable is increasing. If receivable is increasing, received will reduce. If received will reduce, cash balance will reduce. And you can apply this logic on all current assets. Wherever there is current assets, receivable increases, received will reduce. If received reduces, it will reduce your cash balance also. So therefore it will be shown as negative. Then if cash current asset is reducing, debtor is reducing from opening to closing. Why will debtor reduce? Debtor represents receivable. If that is reducing, the only way it can reduce is because you have received it. So if current asset is reducing, received will come into the picture. Current asset is reducing, receivable will reduce. If receivable will reduce, received will increase. If received will increase, cash balance will also increase. That's why it will be shown as positive. If current asset is reducing, let's make a quick review then. If current asset is reducing, receivable is reducing. If receivable is reducing, received is increasing. If received is increasing, cash balance is also increasing. Okay, next let's talk about current liability now, where payment is involved. Current liability represents payable. Creditor, if you understand, creditor represents payable. If current liability is increasing, payable is increasing. If payable is increasing, paid is reducing. So current liability increasing, payable is increasing. If payable is increasing, paid will reduce. If paid will reduce, cash balance will increase. Inverse relationship. More the liability, lesser the payment. Lesser the payment, more the balance, because you have not paid for it. So therefore it is positive. We are checking the impact on the cash balance. So if current liability current liability increases, payable increases, paid reduces, so therefore balance increases. Now current liability is reducing, payable is reducing. If payable is reducing, paid will increase. More you make the payment, lesser the balance. So that's why it is negative. Okay, so that is the logic which we need to understand. But say in the exam, sir, it is very difficult to remember all these logical points. We can do it in day-to-day life, but in exam hall it is difficult. Remember one of them. So increase in current asset is negative. Rest all will run in inverse relationship. Even that can also be done. Okay. Now once you make this working capital change, you'll again go back to the same stuff. You have to reduce income tax paid, and again you will get cash from operating activity before extraordinary item. Then make the adjustment to extraordinary item. Ultimately you will get cash from operating activity. Okay, so this is how you need to consider the indirect method. I hope it is clear. Now what some people do is, or even in some of the study material answers as well, they have started the answer with profit before tax. So to calculate profit before tax, they do another working where they make all these calculations. Profit transfer to balance sheet, add back appropriation, all those things will be done. Any of the two you can follow from the exam perspective. That presentation, anyhow we have got that liberty to present. Okay, so this is what we got to follow when it comes to operating activity. Investing and financing is quite simple since they are one-time elements. We will be writing the statement directly. If it leads to cash inflow, positive. If it leads to cash outflow, negative. Ultimately leading to net increase or decrease in cash and cash equivalent. Add the opening balance to get the closing cash, and that closing cash should tally with the balance sheet. Okay, so this is the preparation mechanism of the cash flow statement. Now for analysis purpose, I will now try to simplify this analysis for you. You can keep this chart as reference whenever you do cash flow statement. Obviously the exams are nearing, so therefore when you are dealing with it, keep this analysis for some of the questions. Once you get the trick of those analysis, then you can start applying directly to save time, at the same time to get the proper reasoning understanding of the same. Okay, see, every time when they ask you, and I will now try to bring it up from indirect method point of view. If I am following indirect method of preparing the operating activity and preparing a cash flow statement overall, when you do the analysis part, you can now start looking into certain factors. Different types of questions can be given by the institute. Sometimes they give statement based questions, sometimes they give balance sheet and ask you to do it, etc., etc. Okay. Now every time you make the analysis, you will make the analysis of P&L also, you will make the analysis of balance sheet also. Whenever you make the analysis, just to see whether it will lead to P&L or there is no P&L. Okay, and I am talking about indirect method. So whenever you do any analysis of yours, see whether it is getting routed through P&L or whether it is not getting routed through P&L. Okay. Now in both situation, if it is, I'll now first talk about if it is routed through P&L. Is it non-cash item or is it cash item? Okay, is it a non-cash item or is it cash item? It has been routed through P&L, bifurcation, non-cash item and cash item. If it is non-cash item, then you have to reverse in operating activity. Why? Because we are saying we are following indirect method. What's the base for indirect method? P&L. In that P&L there is a non-cash item, which means you have to reverse that in operating activity. Example, best example is depreciation. So depreciation, once you get it, it's an item running through P&L, and whether it is cash or non-cash, it is non-cash. So what should I do? Reverse depreciation in operating activity calculations. Okay. Suppose if it is cash, then what should I do? You have to decide which activity you are talking about. Is that cash item related to operating? Is that cash item related to investing? Is that cash item related to financing? Okay. Now let's try to understand this. This cash item is already included in P&L. So therefore, what should I do then? There is P&L item. This P&L item is also a cash item, is also an operating activity item. Which means while making the profit, already this operating activity item is considered, which means ignore. You need not make any change. You are calculating indirect method. Indirect method, what do you need? Cash from operating activity. Base is profit. In that profit, already a cash item related to operating activity is included. Then you need not include once again. It's already there. So ignore it for the time being. So for example, they want you to follow indirect method. This is salary paid is 80,000. Salary paid is a P&L item. It will come in P&L and it's operating. It's paid already. So therefore, you need not make any change. In that profit, already it is included. Suppose if they are investing or financing activity, then what should we do? First, you have to reverse operating activity, then provide this in respective activity, investing or financing. Example, interest on debenture. Interest on debenture is paid. Okay, payable will not come anyhow. Interest on debenture is paid. If interest on debenture is paid, it's a part of P&L because it's a part of finance cost. So P&L it's already included. But is it related to cash item? Yes, it is paid. But is it related to operating activity? No. It is financing activity. So what should I do? In operating, you reverse it. Since it is paid, in financing activity, you provide it. Okay, so that is what we got to do when it is routed through P&L. Now, if it is not routed through P&L, the analysis will remain the same. If it is not routed through P&L, and again make the bifurcation, if it is non-cash, not routed through P&L and it is a non-cash item, completely ignore it because it should not form part of cash flow statement. It is not even included in P&L also, which means I need not make any adjustment. Ignore it. I'll tell you one example. Let's assume that investment is sold, which I think you might have studied in some of the questions also. Investment is sold and profit is transferred to capital reserve. Investment is sold and the profit is transferred to capital reserve. Investment sale, let's not talk about it because sale will contain cash flow. But let's talk about this part. Profit is transferred to capital reserve. Whether there is cash flow in profit? No. Cash flow is there in sale proceeds, but there is no cash flow in profits, correct? So at that time, what should I do? Whether this profit is routed through P&L? No, it is routed through capital reserve. It's a non-cash item. It is not included in P&L. Then ignore that effect itself. We don't want that effect. Okay, so those things completely excluded. It's a non-P&L item, but there is cash involved. Non-P&L item, cash involved. At that time, again, it can be three: activity, operating, investing, financing. But are they included in any of the calculations we have done before? No, because in all of these, the only base you are holding is P&L, and I am saying it is a non-P&L item. So what should we do? You have to provide in respective activity. If you are able to apply whatever you have done in cash flow in this analysis chart, then I would say your entire cash flow preparation will be very easy. Again, I am saying when we follow indirect method, because in direct method we don't have profit base. We directly hand pick whatever is needed and we apply. But indirect method, you have got one base. From that base you are deriving everything, isn't it? So whatever you do, I'll take some examples now and I will put that in the analysis chart. Easily we'll come to know how do we apply that in the cash flow statement. Okay, let's take some examples. Number 1, interest on investment. Let's try to learn from both perspective. Receivable, received, because any of the two, both are possible. So some of the interest might be receivable, which is an asset for you. Some of the interest might be received. Any of the two would be okay, correct? Now, interest on investment. We know that when we follow P&L, it doesn't matter whether it is received or receivable. Both will follow P&L. Both should be other income in P&L. Now, let's first talk about received. Interest on investment is received. Okay. Now, in that case, is it a P&L item? I will change the color. Yes. Is it a P&L item? Yes, sir. It's a P&L item. Whether there is cash flow involved over there? Yes, because interest on investment received. We are talking about that part. Whether there is cash involved? Yes, sir. Now check which activity we are talking about. Interest on investment is investing activity. So what should I do? In operating activity, reverse it, provide it in investing activity. Simple. What about interest on investment receivable? Again, is it a P&L item? Yes, sir, it's a P&L item. Whether cash has been received? No, sir, because it is receivable, so non-cash. So what should I do? The only thing you got to do is reverse from operating. Don't provide anywhere. Everybody are able, I hope everybody are able to understand this, correct? Now, let's take some more examples. Let's try to apply this in the analysis chart. The second example what I will take is another very famous one, interest on debenture. Again, paid, payable. Let's try to apply this. Interest on debenture. Let's first discuss paid. Interest on debenture, is it a part of P&L? Yes, sir, it's a part of P&L. If it is paid, whether it is a part of cash? Yes, it's a part of cash. Is it operating activity? No, it's not operating. So therefore, reverse from operating, provide it in financing. Okay, provide means what? If it is inflow, positive, outflow, negative. Here it is interest on debenture, paid, so it is negative. Okay. Reverse means what? Whatever is already done to calculate P&L, you are giving an opposite effect. So what will happen when it comes to interest on debenture? Tell me. You will reduce interest to get profit. So reversing means what? Add back. If you have added to get profit, reversing means what? Deduct. Okay. Now interest on debenture payable. If interest on debenture is payable, is it routed through P&L? Yes sir, it is routed through P&L. Is there cash involved? No, it's non-cash. So the only thing I have to do, reverse operating activity. Okay, so any examples you can pick up. If you are able to analyze like this, you can apply that in the cash flow statement. Alright, so what is the overall logic what we have done here? From all the accrual mechanism, we have made sure that we got the cash mechanism out of it. And not just that, since AS have provided all the cash should be divided into activities, we are getting it in the respective activities also. Okay, now let's take some more examples. Fixed assets. Okay, what can happen to fixed assets? Tell me. Possibilities are, you have purchased fixed assets, you have sold fixed assets, and there is depreciation. These are the three major possibilities when it comes to fixed asset, isn't it? Now, first let's talk about depreciation. Again, apply this in the chart now. Depreciation, is it running through P&L? Yes sir, it is running through P&L. Is it non-cash or cash? It is non-cash. So the only thing I have to do, reverse operating activity. Okay, so depreciation, the only thing I have to do is reverse operating activity. Now purchased. Okay, let's assume that it is purchased by cash, or else I can go with alternatives for this also. Purchased through other consideration, cash consideration. Fixed asset is purchased through other consideration like issue of share, barter system. I gave one asset, I got another asset. So other consideration, or fixed asset is purchased through cash. Any of the two would be okay, correct? Now, if it is other consideration, then again let's make the analysis. If we buy fixed asset, do we consider P&L for the same? No. So this time it will come under no P&L. If it is no P&L, again we need to check whether there is cash flow. If I am saying that I have purchased fixed asset through other consideration, then is there any cash involved? No. So it is non-cash. So what should I do? Completely ignore this. It will not be a part of cash flow statement. The next thing, suppose if I have purchased fixed asset for cash, is it a part of P&L? Yes sir. Sorry, it's not a part of P&L. But whether there is cash flow? Yes sir, there is cash flow. Now put it in the respective activity. So what should I do? Provide in investing activity. As simple as that. When it comes to sale, what should I do when it comes to sale? Now when it comes to sale, again in sale also there will be two things. One, sale proceeds. Second, profit or loss on sale. Okay, sale proceeds, profit or loss on sale. Now sale proceeds, I hope everybody remembers the chart now, and everybody would have written that chart in your book. So you make the analysis now. I will not scroll up and down, it will become difficult. So sale proceeds, if you think about it, whether P&L is involved? No, so it's a non-P&L. Whether there is cash involved? Yes, because when you sell you will get money. So there is cash involved. If it is cash involved, what should I do? Provide investing activity. Simple. What about profit or loss on sale? Is it routed through P&L? Yes, because profit or loss on sale of asset will be transferred to P&L account. So it is routed through P&L. Sometimes it may not be routed through P&L. I gave you this example, correct? At that time, your analysis will change accordingly. My assumption is profit or loss on sale is transferred to P&L. So there is P&L involved. Whether there is cash involved? No. 100 rupee asset is sold at 120. So 120 sale proceeds contain cash flow. Profit or loss of 20 rupees do not contain any cash flow. It's just a representation that whether you sold the asset at more than cost or less than cost. So therefore, for profit or loss on sale, there is no cash flow involved. So therefore, what is the only option then? Routed through P&L, non-cash. The only thing what we got to do is reverse operating activity. Okay, so if you give me any examples, we can make the analysis over here. But this is exams, correct? Any type of possibilities are available with us. If you are able to understand it, sale proceeds plus or minus profit or loss on sale is equal to book value of the asset. Isn't it? Let's take an example. Suppose if I have sold the asset for 150 and I have made a loss of 30 rupees. Now what happened? The asset value was something. I sold that asset and I made a loss of 30. Then what happens? Your original value of the asset was more. You sold at a loss, you got a lesser proceeds, correct? So what happens? The book value of this asset is 180. Sometimes in the exam what happens is, they'll give you this data and this data. At that time what should I do? Because book value, there is no cash flow. Book value is what value we have represented in the books of accounts. So in book value there is no cash flow. Profit or loss, there is no cash flow. Where is the cash flow? Cash flow is on the sale proceeds. So if they give you book value, if they give you profit or loss on sale, what should we do? Convert this into sale proceeds. How can I do it? Either it is book value minus loss is equal to sale. Book value plus profit is equal to sale. And needless to say, this profit or loss will be routed through P&L and reverse operating activity will work there. Sale is not routed through P&L, it is directly coming under provide in investing activity. Okay, so any type of complication may arise. Our job is to stick to the basics and see what's happening from accrual to cash conversion and work it out accordingly. Okay, now one last analysis. With this I think most of them is understandable, or maybe I'll make two analysis. With this most of them will be understandable for you and you can apply your own mind and you can work out the problems. Okay, I'll take up one of them, which is provision for bad debt, or you can take bad debt, discount on debtor. All these things will have same effect. Okay, now all these three, if you make the analysis now, all these three represents an expenditure, which means it's a part of P&L, isn't it? If it's a part of P&L, again we make the analysis whether it is cash or non-cash. You can think about it. PBD, provision, bad debt, discount. All these three are non-cash. So therefore it is non-cash. Therefore the only thing I have to do is reverse operating activity. But your discussion doesn't stop there. Your entire indirect method operating activity is bifurcated into two things: impact on profit, impact on working capital. If you think about it, debtor is a working capital account. And how do you get closing balance of debtor? Closing balance of debtor is ascertained after reducing bad debt, after reducing PBD, after reducing discount, etc. Which means in debtor, which is a working capital account, there are non-cash items included. Then you can't make cash flow analysis, correct? Which means from this debtor also you should reverse all these effects. Because it will apply to P&L, you reverse operating activity. That is understandable. Because it is now applying a working capital account, which is also a part of cash flow statement, operating activity itself, you have to reverse any non-cash item included in a working capital account also. Okay, so that will apply for all your items included in working capital. Suppose if there is discount received, that time what happens? This will impact your creditor account. Now discount received is also a part of P&L, therefore the only thing to be done is reverse operating activity. Discount is a non-cash item included in the working capital account. What should I do? Reverse this in creditor account also. Okay, reversing means what? From debtor you deducted all these things to get the final debtor balance. Add back. So when you do working capital analysis, after adding back whatever value you get, that has to be considered. Okay, I hope this is clear. So any non-cash item affecting your working capital should also be reversed. Then only you can get a proper cash flow effect out of it. Okay. This is one thing. The next one. What if the question tells you about advance tax? Or let's try to learn tax itself in general. In general, let us try to learn the tax itself. Now, when it comes to tax, what did we learn? In cash flow, only taxes paid needs to be considered. Isn't it? Only this will come in cash flow. There is one more thing related to tax called as provision for tax. And we know that this should be reversed because there is no cash element involved there. That should be reversed. However, whenever we do taxes, if nothing is mentioned, we normally apply one general assumption. Okay, if nothing is mentioned related to taxes, sometimes they mention something. They say taxes are paid to this much during the year, or this much of taxes provided during the year. Now, if those information is given, then no issue. If nothing is mentioned about taxes, the general assumption is opening provision is paid. Opening provision means what? Last year taxes are paid in the current year, and closing provision, which is current year taxes, are provided. Okay, so let's assume opening provision is 100 rupee, closing provision is 150 rupees. Opening provision, general assumption is what? Is paid during the year, which means 100 is paid, 150 is provided. 100 paid, what should I do? It is taxes paid, it's a part of cash flow statement. 150 provided, what should I do? It's a part of provision, so reverse. Okay, that is our general assumption. Opening provision represents last year taxes paid in the current year. Closing provision represents current year, so it will be provided in the next year. Okay, this is when it comes to application of provisions. Okay, but there is one exception to the rule called as advance tax. What is the meaning of advance tax? We have already learned taxes. We know that at certain circumstances, even though the normal rule is income of 1 year, tax is paid in the next year, but when it comes to advance tax, whatever income is earned, the taxes are paid in this year itself. Isn't it? Which means current year advance tax is current year payment. So directly apply that in the cash flow statement. Example, last year data, they said last year advance tax is 100 rupees, current year advance tax is 250 rupees. What is the meaning? Last year itself we have paid 100 rupees, current year itself we have paid 250 rupees. We are doing current year cash flow statement, so only consider current year data at that time. Provision, if it is given, it means it is payable. So last year is paid in current year is provided. Advance tax means it is paid, it's a part of asset. It is already paid. So current year advance tax is paid in current year itself. Directly consider that data itself. Okay, so that's how you got to deal with taxes when it comes to the preparation of cash flow statement. Okay, so are we able to understand all these things? My suggestion would be to go through this chart clearly. Whenever you get any complication as such, try to revolve around this one itself, so that you'll get some basic understanding about it. Once you get the basic understanding, even if complication arises, it might go beyond this chart also. For example, that discount on debtor which we spoke about, it's not only restricted to this chart, we increased our learning also, but still at that time at least the connection will become much easier. Okay, that is what I feel. Even you can provide your feedback about this and tell me whether this chart worked for you or not. If at all you find that it is worked, I'll be very happy about it. If not, at least I can improve. I can add up some more points on this chart itself so that it becomes easy for the future people as well. Okay, so this is the analysis theory when it comes to the cash flow statement. Based on this, let us look into certain problems. Let us see whether we are able to understand those problems clearly or not. Okay, I hope this theory is clear. If there are any doubts, you can ping me up. You can send me your doubts to this number. I use WhatsApp as well as Telegram on this, or you can ping me in Instagram as well. You can follow me on Instagram. This is my handle. Okay, so whenever you have any doubts, you can send it over. After looking into it, I can reply it back to you. Okay, so this is the theory requirement of cash flow statement based on this. Now let us take up some problems based on the theory whatever we have studied. Let's go with the first question. I have taken almost all the questions from the RTP and MTP available. So let us start discussing one by one. From the following details relating to the accounts of Omega Limited, prepare cash flow statement for the year ended 31st March 21. Share capital, GR, P&L account, debentures, provision for tax, trade payable, plant and machinery, land and building, investments, trade receivables, inventory, cash in hand and at bank. Depreciation at 20% was charged on the opening value of P&M. At the year end, one old machine costing 70,000 was sold for 49,000. Purchase of machinery was also made at the year end. Rupees 70,000 was paid towards income tax during the year. Land and building is not subject to any depreciation. Expenses on renovation of building amount rupees 2,80,000 were incurred during the year. Prepare the cash flow statement. Okay. So whenever a cash flow statement is given for us, we know that investing and financing activity are under direct method, no problem. First decide for operating activity whether it is direct method or indirect method. If the question tells you specifically what to be done, then no issues at all, we can follow it. Suppose if the question does not tell you, at that time you have to take hints from the question. If at all they want you to follow direct method, they will give you individual data so that you can pick up whatever is required, like cash sales, payment of salary, all those specific items they have to give so that you can pick the data and apply here. But if that is not given, instead P&L balance sheet base is given, then we have to follow indirect method. There is no choice. Okay, so we have to follow indirect method over here. Suppose if we have to follow indirect method, what should be our approach while making the answer? Before you start up with your main answer of preparing the cash flow statement, make sure that you make initial analysis. It will be a working. How to prepare this working? That working will be either a one-line working or it can be an account working. Use your one-line working or one-line analysis whenever there is direct understanding about that point. Don't create account for everything. It will be time consuming. But if there are more data given in the question, prepare a account so that it will become very easy for you to apply that in the answer. Okay. Now, in all this analysis, what are we searching? Why do we make this analysis? In this entire analysis, search for whether there is a P&L impact and whether there is cash impact. If you remember the chart now, if there is P&L impact, we know it might affect the operating activity and all. If there is cash impact, again we know it might affect any other activities also. So therefore, you see whether there is P&L impact and cash impact. Then you can apply the chart. If it is P&L non-cash, then reverse operating activity. P&L and cash, then see which activity it belongs. Not P&L but there is cash, then see which activity it belongs, ignore, etc. Okay. So for that reason, get this two analysis done correctly. Some items will be only P&L, some items will be only cash, some items will be both. So at that time your analysis will change accordingly. Okay. Now, before you jump into that analysis, first remove all those working capital accounts, because working capital accounts anyhow increase or decrease is directly analyzed in the cash flow statement itself. So you need not make separate analysis in your initial working. So in this entire thing, I think trade payable is a working capital account. Trade receivable is working capital account. Inventory is working capital account. Okay, so therefore I will consider these three first. Exclude these three, we'll discuss it later. Now let's start with the initial analysis of other accounts. I'll start with share capital. Now if you see this share capital is on the increasing order and it is getting increased by 2,80,000. From 11,20,000 it is getting increased to 14 lakh. This is opening, this is closing. So why it is getting increased? Because of issue, and that issue will lead to cash. If nothing is mentioned in the question, issue is most of the time it is done for cash purposes only. Next, general reserve. This is also getting increased from 3,50,000 to 5,60,000. So there is a difference of 2,10,000. And therefore, why is this getting increased? Because current year there is an appropriation. So P&L is the reason why that increase took place. From total profit of this year, you transferred some value to GR. Okay. Next, check the difference in P&L now from 84,000 to 1,40,000. So there is a difference of 56,000. Now, why is this getting increased? Opening P&L we already had 84. Current year it turned into 1,40,000, which means this is your current year profit. If you remember our indirect method chart, current year profit is a starting point. From that, you add back appropriation, add back provision, all those things will be done, correct? So this relates to that point. Now check debenture. From 0, it is getting increased to 2,80,000, which means there is a difference of 2,80,000. Why this difference arose? Because we made the issue. Whenever there is issue, there is cash involved. When it comes to provision for tax, I do agree that there is an increase in provision, but there is an additional information given for us. It said 70,000 was paid towards income tax during the year. Whenever these kind of information is given, at that time, my suggestion would be to create the account itself, provision for tax account. It's a liability account, which means opening credit balance will be there. So by balance brought down, the amount is, opening is 98, closing is 1,40,000. Okay, so 98,000 to balance carried down 1,40,000. Next, according to the question, we paid tax to the extent of 70,000. So to cash 70,000. Therefore, by P&L will be balancing figure. 2,10,000, 98 means 1,12,000. Okay, now if you see, there is P&L impact also, cash impact also. What will happen with P&L impact? It gets added back because it is provision. Cash impact in operating activity, taxes paid. Over there we will be using it. Okay. Next, trade payable is a working capital account. We need not analyze. Plant and machinery. There is an increase first of all, yes, but along with that there are some adjustments also. So therefore, let us do one plant and machinery account, where opening, this will be an asset. This is the account to be considered. It's an asset. So to balance brought down 7 lakh, the opening balance. By balance carried down 9,80,000. Now let's read the adjustment there. First, depreciation at 20% was charged on opening value of P&M. So on opening value of P&M, there is depreciation to be levied. So by depreciation, this is P&L basically, because depreciation will ultimately go to P&L. 7 lakh into 20%. So 1,40,000. 1,40,000. Next, there is one more point mentioned. At the year end, old machine costing 70,000, WDV 28 was sold for 49. Purchase of machinery was also made at the year end, which means depreciation no impact because everything is done at year end. Now, whenever there is asset account created, which is basically fixed asset account, that fixed asset account can be created in two ways. One, they can create in cost basis. Second, they can create it in WDV basis. How do we come to know that whether it is cost basis or WDV basis? If cost basis is followed, the asset account will be created at cost. All the depreciation will be accumulated separately as accumulated depreciation account or provision for depreciation account. If at all provision for depreciation account is not created, then all depreciation changes will be done in asset account itself. Okay, in this question, do we have provision for depreciation? No, which means the entire account is done on WDV basis. Suppose if cost basis is done, what should we do? Then only cost changes will be made. All the depreciation changes will be made in provision for depreciation account itself. Okay, so therefore, in this question, since they have followed WDV mechanism, I will ignore cost, I will consider WDV. WDV worth 28,000 is sold for 49,000, which means there is a profit of 21,000. How do you apply that in the account now? By bank, 49,000 to P&L, 21,000. Again, there is a P&L involvement, there is bank involvement, both are there over here. Okay. Finally, they said there is a purchase involved, even that also will be to bank or cash. Any of the two would be okay. So to bank. So what's the balance we get? 980, 1,40, 49 minus 7,21. So we get 4,48 as bank. This is purchase. So just to make that chart analysis type, there is P&L, but it is non-cash, isn't it? So P&L non-cash, what should I do? Reverse operating activity. There is bank here, no P&L, only bank, which means we have to provide in the respective activity, which is investing here. Again, there is to bank, not routing through P&L, so therefore directly provided in investing activity. Cash inflow is positive, outflow is negative. Okay, so P&M is also analyzed. Now land and building. The difference between this is 2,80,000, and if I remember correct, there is a point mentioned about it. What is the point mentioned? Land and building is not subject to any depreciation. Expense on renovation of building amounts to 2,80,000 were incurred during the year, which means this entire 2,80,000 has been incurred, which means no depreciation, everything is cash. Okay. Next, investment from 0 to 1,40,000. There is a gap of 1,40,000, which means it is getting increased. This year we have purchased, so cash. Trade receivable and inventory are working capital account, ultimately leading to cash and bank. So all other analysis is over, and accordingly now let's make the analysis of the working capital also. Let's start with trade payable. Trade payable from 11,48,000 it got reduced to 9,80,000, which means payable is getting reduced. If payable is getting reduced, payment increases. If payment increases, the balance will reduce, which means I have to reduce this negative. Okay. Next, trade receivable, see 9,80,000 to 7 lakh, which means from 9,80,000 it is getting reduced to 7 lakh. Receivable is reducing. If receivable is reducing, received is more. The more I receive, the more the balance of cash I get. More I pay, lesser the balance. More I receive, higher the balance. Next, inventory from 2,80,000 is getting increased to 5,60,000, which means receivable is increasing, received will reduce, automatically the balance will also reduce. This is how the analysis should be made. So we made all the analysis given in this chart. We saw all the working as well. Depreciation is done, cash payment is done, land and building is done. Now once all the analysis is over, apply that in the cash flow statement. So let's make a quick understanding now. See, increase in P&L, current year profit, we have already made the analysis. Provision for tax in the account we have seen by P&L 1,12,000, that is also done. Transfer to general reserve, we got this difference 2,10,000. From profit you would have reduced it to get the GR value. Now add back. Next, depreciation, non-cash, should be added back, reversed. Profit on sale of machinery, as I have told you, profit, you add it to get the ultimate profit. Profit on machinery will be added to get the ultimate profit. So here we have to reduce it. Next, there is increase in inventory, so it is negative, already analyzed. Decrease in trade receivable, so positive, analyzed. Decrease in trade payable will be negative, payment will be more, balance will be less, this is also analyzed. Now, income tax paid will come into the picture. Finally, we get the operating activity. Then cash from investing activity, purchase of machinery was there, we got this as balancing figure. Cash is going out, so negative. Then sale of machine took place, cash is coming in, so positive. Investment is getting increased, so we purchased investment, negative. Building, we incurred certain expense, again cash is going out, negative. We get the net investing activity. Financing activity, issue of share, cash is coming in, positive. Issue of debenture, cash is coming in, positive. So ultimately, we get the net change, add the opening balance to get the closing balance. So if we check here, we get the final analysis. So between the two, there is no change. So opening and closing remains the same. So add opening to get the closing. So that's how cash flow statement can be done. Okay, so all these will be your analysis part. So see, even institute has created account for the same we have also created. Okay, so initial problem, if we get a hold on it, later problems, even if I go a bit fast, I hope everybody will be able to follow. Okay, so let's move to the next question. The following are the extracts of balance sheet and statement of P&L of Supriya Limited. Extract of balance sheet, equity and liability, shareholders fund, share capital, non-current liability, long-term loan from bank, current liability, trade payables, assets, non-current assets, property, plant and equipment, current assets, trade receivable, cash and cash equivalent, the cash balance. Extract of P&L, expense, employee benefit expense, other expense, tax expense, current tax paid during the year. Notes to accounts, share capital, then other expenses, which is overhead. Prepare cash flow statement of Supriya Limited for the year ended 31st March 21 in accordance with AS3 using direct method. All transactions were done in cash only. There were no outstanding or prepaid expense as on 31st March 20 and 21. Ignore depreciation. Dividend amounting to 80,000 was paid during the year ended 31st March 21. So this is a question which is on direct method, which means we have to hand pick all the operating activity, investing activity, financing activity requirement. Okay. Now let's again make the analysis. Let's start from the beginning. Let's decide the working capital. Okay, here there is no need to decide the working capital account directly because working capital changes is an indirect method requirement. So let's make a line by line understanding and move on with it. Okay. Now starting with share capital. From 200 it is getting increased to 500. So there is a 300 issue. Cash is involved. Next, non-current liability. From 250 it is turning into 0. This is opening, this is closing. From 250 it is turning to 0, which means there is a gap of 250. Again cash is paid so that it will turn 0. Trade payables, from 3047 it turned into 1000, which means what? I have paid for it, because we have to follow direct method, isn't it? If I am following direct method, I have paid for it. That's why it got reduced, which means again cash is involved. The difference is 2047. Next, property, plant and equipment, from 128 it turned into 230. They are asking you to ignore depreciation. So what's the difference? 230 minus 128, 102. So 102, cash is paid. Everything is done in cash. The only thing what we have to decide now is whether it is positive or negative. This is positive because share is issued. This is negative because we paid for it. This is negative because we paid for it. This is negative because we have paid for it. Okay. Next, Current asset, trade receivable is decreasing. If receivable reduces, then received increases. So this is positive to the extent of 2783. And finally, cash and cash equivalent, anyhow we'll make the ultimate analysis. When it comes to expenses, it's nominal account. I can't compare it with the previous year. All expenses are paid during the year. So these expenses will directly come as current year once itself. Current year, these much expenses are paid because the question told you all are cash transactions only. Okay, so this is directly paid, will come in operating activity in front of it. Next, tax expense of current year needs to be considered because it is paid during the year. Shall I apply the general assumption? No, because the question specifically told you current tax is paid during the year. So this is paid directly, that itself will be considered. What about this 140, sir? It is paid in the last year, so it would have come in the last year cash flow. Okay, so now the analysis becomes much easier then. So based on that, one last thing which I have given here, dividend amounting to 80,000 was paid during the year. So what should I do? Directly consider this in financing activity. Okay, shall we look into the solution then? See, receipt from customer. We are following direct method. So receipt minus payment. So receipt from customer 2783. Trade receivable gave you that info. Payment to supplier. Trade payable gave that info. Since it is payment, negative. Cash paid to employee. This is expense. Then other overheads paid, expense. Cash generated from operation before tax. Income tax is paid current year, what we discussed, that itself will come. We get cash from operating activity. Then investing 102 we paid for purchasing the asset, negative because we paid for it. Financing activity 300 we got from issue of share, 250 we paid the loan payment, so negative. Finally dividend paid. Ultimately you get net change, add the opening balance to get the closing balance. So everywhere it's all about how do you approach the question. Indirect method, the approach is I want to see how it will impact P&L, and wherever cash is involved, how will it impact the cash. But when it comes to direct method, everything you check only from cash point of view. P&L is not needed because there is no base, isn't it? So therefore everything is checked through cash mechanism. If there is no cash involved, ignore it completely, if at all you are following direct method. Indirect method, since profit is the base, the changes will be made accordingly. Okay, now I hope this is clear. Let's move on with the next question. On the basis of the following information, prepare a cash flow statement for the year ended 31/3/21 using direct method. Total sales for the year were 597 crore, out of which cash sales amounted to 393 crore. Let's make the analysis here only so that we'll save time. On the basis of the following information, prepare cash flow statement using direct method once again. Again hand pick whichever is related to that part, we will be picking it up. Let's read the first one. Total sales was 597 crore, out of which cash sales amounted to 393 crore. Which means the difference is credit sale. In credit sale, there is no cash flow. Receipt from debtor, there is cash flow. Credit sale, no cash flow. So directly 393 crore needs to be considered, isn't it? Because only cash sale there is cash flow. Direct method we are talking about. Receipt from credit customer, we need not calculate, they themselves gave it, which means directly this 201 will be a receipt for us. Let's keep it positive because both of them are receipt. Next, purchases for the year amounted to 330 crore, out of which credit purchase were 80%. So total is 330, in that 80% is credit. Credit purchase, do we have cash flow? No. Payment to creditor, there is cash flow, but credit purchase, no cash flow. Cash purchase, there is cash flow. So therefore, how much is cash purchase then? It is 330 into 20%. So 66 negative because it is outflow. Next, what about payment to creditor? They did not give you payment like they have given over here, but instead they gave you the opening closing balance. Do we remember? If we remember creditor account, by balance brought down, opening balance, by credit purchases, purchase during the year, to bank and to balance carried down. So to get that bank, what should I do? Opening plus credit purchase minus closing. This is what we got to do. So opening is 126. Add purchases. Credit purchase should only be considered. So 330 into 80%, which is 264 minus 138. Ultimately, how much do we get? 126 plus 264 minus 138. So 252. Ultimately, this 252 is negative because that much is payment to creditor. Okay. Next, suppliers of other consumable and services were paid 28.5 crore in cash. So negative 28.5. This is operating itself because it is day-to-day activity. Employees of the enterprise were paid 30 crore in cash. Direct salary is also operating itself. Fully paid preference share of face value 48 crore were redeemed. So negative 48 financing activity because it is redeemed. We paid. Equity shares of face value 30 crore were allotted as fully paid up at a premium of 20%. So 30 plus 20% is 36. That is positive because shares are issued financing activity. Debentures of 30 crore at a premium of 10% were redeemed. Debenture holders were issued equity shares in lieu of their debenture. So in place of debenture, we are giving equity share. Is there any cash flow involved here? No. So completely ignore. Because we are following direct method, P&L impact is not required at all. And if cash is there, it's a part of cash flow statement. If cash is not there, ignore. Okay. Next, 39 crore were paid by way of income tax. So operating activity, taxes paid, negative 39. A new machinery costing 15 crore, okay, was purchased, which means 15 negative. Investing activity, investing. Investment costing 27 crore were sold at a loss of 3 crore. This is what I meant when I gave you the theory understanding. Costing 27 crore. Is there any cash flow in that costing? No. It's sold at a loss of 3 crore. Is there any cash flow in loss? No. There is cash flow in sale proceeds. How do we get sale proceeds? Book value minus loss is equal to sale proceeds. So 24 investing activity positive because in sale proceeds there is cash flow. And should we consider that 3 lakh loss and all? No need. Why? Because we are following direct method. Indirect method only we would have added back. Direct method there is nothing to be done. Okay. Next, dividends totaling 22.5 crore were also paid. So 22.5 negative financing activity. Debenture interest 3 crore was paid. 3 crore again financing activity. So considering this, we have to apply it in the cash flow statement. Opening balance is 3 crore, which we will be adding at the end. So now things will become very easy. Check here. 393 cash sales discussed. 201 receipt from debtor discussed. Cash paid to supplier, goods, services and employee. We have already considered it. See, if you check the working, 126, okay, wait, 66 cash purchase, 252 payment to creditor, then 28.5, 30. All of them were negative. So they have included everything and they have brought it in one line. Okay, you can show it separately in the exam, no issues. Next, income taxes paid, we get the operating activity. Investing, we saw machinery is there. Check here, the sale of investment, we have to consider only the sale proceeds. We got the investing activity. Financing 48, redemption of preference share. 36, issue of shares. 3, debenture interest paid. 22.5, dividend paid. So ultimately for the value, add the opening balance to get the closing balance. Okay, so here is the way in which I hope the calculations are easier now. Next, following is the balance sheet of Fox Limited. You are required to prepare cash flow statement using indirect method. So again it will come back to profit impact and cash impact. Okay, so equity and liability, shareholder fund, share capital, R&S, current liability, trade payables, short-term provision, provision for taxation. assets, non-current assets, property, plant and equipment, current assets, inventory, trade receivable, cash and cash equivalent, other current asset. Notes to accounts for share capital and R&S have been provided. Ultimately, additional info, dividend paid during the year is 10,000, depreciation charges during the year is 40,000. Now based on this, we have to prepare cash flow statement using indirect method. Now we know the situation through which it should be worked out. So again, let's make the account analysis first. Trade payables will be a working capital account, so we'll not be considering it for the time being. Provision for tax, don't consider it to be working capital account because it is related to taxes. That we have discussed that if any payment and all is made, then you have to follow that payment methodology. If nothing is given, then last year provision is paid during the year, current year provision is provided. Okay. So keeping this in mind, let's analyze the equity and liability first. Share capital, there is a note here. Let's go to the note quickly. Equity share capital have increased from 2 lakh to 4 lakh 10. So 2 lakh 10 issue has taken place. Next, preference capital from 1 lakh to 1 lakh 50. So 50,000 issue has taken place. Both are positive because cash is coming in. Which activity? Financing. Okay. Next, R&S also there is a note. So let's see what the note is all about. Surplus in P&L at the beginning of the year. This is opening balance. Add profit for the year 10,000. Less dividend 20,000. Surplus closing 35. So 25 plus 20 minus 10 is 35. Okay. Now the thing is, if you have taken profit transfer to balance sheet, from that you got to first get the difference of opening to get the profit for the year. Instead of that, what can be done? You can do two things. One, you can directly consider profit for the year. If you directly consider profit for the year, you need not even add back this dividend. If you consider difference between opening and closing, it will be 10,000. For this 10,000, you should add back appropriation of 10,000, where you will get 20,000. That itself is this value, profit for the year. So therefore, you can take however you want. If you take profit in the balance sheet, profit at the end of the balance sheet, the difference between closing and opening, that anyhow will be, in this situation it is 10,000, add back appropriation 10,000. It is left to you. Okay. So share capital, R&S, both are analyzed. Next, trade payable, working capital. If I have to decide whether it is increase or decrease, 60,000 to 1 lakh 50, isn't it? Yes, closing and opening and closing. 60,000 to 1 lakh 50. So 90,000 trade payable is increasing. More the payable, lesser the payment. If lesser the payment, more the balance. So higher. Short-term provision, income tax, nothing is mentioned. So last year is paid, current year is provided. Paid will impact cash, provided will impact P&L. So provided will be added back, paid will be deducted in taxes paid. Now let's make the analysis of asset. In this asset, property, plant and equipment, only one additional data you have, that is depreciation. Okay. If you want, you can prepare an account also. If you are preparing the account, what happens? 1 lakh 80 is opening, 3 lakh 50 is closing. So by balance, to balance brought down 1 lakh 80 because it's an asset. By balance carried down is 3 lakh 50. Then by depreciation 40,000. By depreciation 40,000. Okay. So if you make these additions, let's quickly check. Yeah, 1 lakh 80 is opening, 3 lakh 50 is closing. Then 40,000 depreciation. So 3 lakh 90 minus 1 lakh 80. 2 lakh 10 will be the cash impact because it is purchase. This is by depreciation. So this will contain P&L impact. By depreciation will go with P&L impact. Yes. Okay. So this is analysis of P&M as well, property, plant and equipment. Next, all our current assets, we have to exclude cash because we will be just adding it up at the end. Let's make the quick analysis. Inventory is increasing. If inventory is receivable increasing, received reduced, balance also reduced. Then trade receivable again increasing, so balance will reduce. Other current asset, it is increasing, balance will reduce. All the analysis is made with this, applied in the cash flow statement. Then, as I have told you, they have considered net profit. Look here, they have not considered profit for the year, they considered net profit. So therefore they have added back appropriation. Okay, so if you don't want, you can directly start your answer with 20,000 also. Okay, then add provision for tax. As I have said, current year is provided, that's why it is added back. Then depreciation should be added back because it is a non-cash item. You will get before working capital change. All the three current assets are negative because all the three were increasing. Trade payable was increasing, so it was positive. Now you got net cash from operating activity for this taxes paid last year closing, current year opening, that will be paid. Then property, plant and equipment 2,10,000. Did it match it with our account? Yes, 2,10,000. So this 2,10,000, since it is purchases, it will be negative. Then leading to closing financing activity, which is equity share issued, issue of preference share and dividend paid. Ultimately add the opening balance to get the closing balance. Okay, so this is how you can easily make that calculations. Okay, institute has done the working in table format, but we can do it in account format also. My suggestion most of the time will be account format only, because it will be easy to express the answer to the examiner. Okay, now let us take up another question. Wherever there is additional analysis involved, some important aspects coming into the picture, let's take up that part only. Other things anyhow it will be easy for us. Okay, the summarized balance sheets of Flora Limited for the year ended 31st March 22 and 31st March 23 are given below. Goodwill, land, furniture and fixture, vehicle, office equipment, long-term investment, stock in hand, bills receivable, trade receivable, cash and bank balance. Liabilities, equity share capital, general reserve, P&L account, capital reserve, 8% debenture 100 each, loan from Mr. Andrew, bills payable, trade payables, creditors for equipment, outstanding expense, provision for tax. Additional info, on 1st April 22, one of the vehicles was sold for 3,000. No new purchases were made during the year. A part of the total land was sold for 1,25,000, cost 1 lakh, and the balance land was revalued. Capital reserve consists of profit on revaluation of balance land. No new purchases were made during the year. Depreciation provided during the year, furniture and vehicles. Interim dividend of 5,000 was paid during the year. Provision for taxation for the year 22-23 was 16,000. Provision is given in the question. 8% debentures were redeemed at par after half-year interest payment on 30th September 22. Part of the long-term investment was sold at a profit of 8,000. Interest income received during the year on long-term investment was 6,500. You are required to prepare cash flow statement from operating activity for the year ended 31st March 23 using indirect method. They have asked only operating activity, indirect method. All working should form part of the answer. Okay, they are only talking about operating activity, which means you need not analyze external liabilities at all. Or if you are analyzing external liability, make sure that you consider only P&L there. Because cash you need not consider. If you consider cash also, it would have come in investing or financing activity. That is not asked anyhow here. Okay, they have given a big question for us, but they have restricted the answer only to operating activity. Okay, so let's make a quick analysis then. Goodwill. From 28,000, it is reduced to 15,000. From 28, it reduced to 15. Why it got reduced? One of the main reason why it gets reduced is because of write-off. And whenever they write off, from where they will write off? They will write off through P&L itself. non-cash. There is no cash involved here. And what's the difference? 13,000. It will be non-cash. Okay. Next, land. If you look into land, what did they mention? There is a point given here. A part of total land was sold for 1,25,000. Cost is 1 lakh, and the balance land was revalued. Capital reserve consists of this profit. Okay, so land account, if we do, what will happen? Land account has an opening balance of 6 lakh. So 2 balance brought down 6 lakh. I will not write the words. Closing balance of 5,75,000. Then what they mentioned? They mentioned that land was sold costing 1 lakh, sold for 1,25,000. On land, no depreciation. So therefore, by bank or by cash, 1,25,000 to P&L. I'll write over here. To P&L, 25,000. Then capital reserve, whatever is created is because of profit on revaluation. So to capital reserve, 75,000. Let's check whether we have any difference now. Debit total comes to 7 lakh. Credit total is also 7 lakh, which means the account tallied. Okay. So because of this account getting tallied, the impact is only in these two now. There is sale and there is P&L. Okay. This sale also doesn't matter because they have asked only operating activity, but this P&L would matter. Okay. So we have done the analysis of land as well. Furniture and fixture. Now in this furniture and fixture, let's see whether there is any additional point mentioned here. Depreciation provided during the year. Furniture is given here to the extent of 5,000. Okay. Now what's happening in this furniture now? From 44,000 it got increased to 48,000. If you imagine the account, opening balance from 44, yeah, opening balance is 44, closing balance is 48, depreciation is 5,000. So automatically the difference will be purchase, which will be to the extent of 9,000. Again, this purchase doesn't make much difference for us. This will come in operating activity because it is reversal. This is depreciation, right? So it will be reversal. Okay. Next, in the same way for vehicles also. Vehicles, what is the data given for us? There is a depreciation applied for vehicle. Also, on 1st April, one of the vehicle was sold for 3,000. No new purchases were made during the year, which means opening or closing date 22 is opening. So on the opening date itself, a sale has taken place. So the only problem for now for us would be, what is the profit or loss on sale? Okay, so if at all there is profit or loss on sale, at that time, that will impact your operating activity, isn't it? So why it will impact operating activity? Because it's a reversal. So accordingly, if we look into it, let's again imagine a vehicle account. I'll erase all these things. Okay, so vehicle from 28,000 it has come down to 22. So 2 balance brought down is 28, by balance carried down is 22. Then there is a depreciation levy for vehicle 2,200. This will impact my operating activity also, depreciation. After that there is a sale to the extent of 3,000. So cash 3,000. Then they are saying no new purchases were made during the year, which means on this 3,000 no depreciation impact because it is sold at the beginning of the year itself. So let's take the balancing figure 25, 27,200, which means there is a P&L loss of 800. Okay, I'll get the balancing figure. That balancing figure will be profit or loss on sale. Okay, so that's how we can do the stuff. What else? Office equipment from 0 to 21, which means it is purchases, no issues. Long-term investment we need not analyze because it will not impact your operating activity anyhow. But long-term investment is getting reduced. Because it is getting reduced, we have to just see whether there is profit or loss on sale. Part of long-term investments were sold at a profit of 8,000. Directly the profit is given for us, we will impact that in the operating activity. Okay. So next thing, let's make quick analysis about these three things because it is working capital now. Stock is increasing, so reduction. Then receivable is increasing, so reduction. Receivable, trade receivable is getting reduced, so increase. Okay. Now once we are done with asset analysis, let's go to the liability analysis. Equity share capital is issue, but only operating activities are, so it doesn't make much difference, but 30,000 will be impacted through P&L, so it's a part of operating activity. Okay. Next, P&L profit for the year, that will be given, so 51,000 I guess, sorry 41,000. Next, capital reserve, we already made the analysis, it got created because of revaluation. Debenture is getting reduced. Okay, it has turned 0, but that is redemption, no issues, but they have redeemed it along with interest. Interest will come in P&L also, and that is a part of financing activity, so I have to reverse it in operating activity, isn't it? So therefore 3 lakh into 8% into 6 by 12, this interest we have to add back when it comes to operating activity. So I think it is 12,000, this should be added back. Okay. Next, loan from Mr. Andrew, it is getting reduced, we are directly going to pay off. Working capital, bills payable, trade payable, creditors for equipment, outstanding expense. Let's apply these now. Bills payable is getting reduced. Payable is getting reduced means payment is more, balance will reduce, so less. This is increasing, so balance will increase, so more. This will be more, and this will be more. It is getting increased. Okay. So ultimately leading to provision for tax. They have specifically mentioned taxes provided is 16,000. So if you imagine a provision for tax account now, by balance brought down is 11,000. By P&L, which is provided, given in the question, 16,000. Then to balance carried down is 18,000. Get the balancing figure, which is bank 27, so 9,000. This will be cash, this will be P&L. Okay, so accordingly, let's see some other adjustments if there are any. Interim dividend 5,000 paid will lead to financing activity, not important. Debenture we analyzed. Part of long term we analyzed. Interest income during the year on long term investment was 6,500. Interest income would have been passed through P&L. So in P&L we have to reverse it. Later we'll provide that in investing activity. Okay. Now let's see what answer has come out. Net profit before taxation is 92,000. How they got net profit before taxation? 41,000 is increase in P&L. We already made the analysis. Then add appropriation, which is GR, and dividend. Because dividend, once it is paid, then it will be reduced from profits also. So add back. Then add back provision for tax. Ultimately, you will get profit before tax. Okay. This provision for tax account is working according to our requirement only. We have already done this. So we got our net profit before tax. Then depreciation, non-cash added back. Profit on sale of land, as I have told you, it's a part of investing activity where profit do not have any cash flow. 1,25,000 has cash flow, so reversed. Loss on vehicle, we got 800. We have already seen the account, so that is considered. Profit on sale of long-term investment, we made the analysis. Interest received, as I have told, here it is reversed, provided in investing. Interest on debenture, again we made the analysis. Debenture interest is reversed here, provided in financing activity. Goodwill written off. Write-off will be done through P&L, therefore it should be added back. Working capital changes will come, where we have already made analysis of all the working capital. Okay, the only difference is in this they have not considered that creditor for equipment as working capital. Okay, it depends upon interpretation. They are not considered here because they consider it to be long term. They will directly consider it under financing activity. Okay, if you consider it to be working capital, it will be a part over here. Then income tax paid, ultimately leading to cash from operating activity. Alright, so that is how you have to make the analysis when it comes to operating part. Chalo, I hope this is clear. Okay, let's take up the last question on this cash flow. So basically we are now just learning which activity it will belong to, so that it's a very small thing. The only thing is now we have to analyze where we are supposed to write. Now dividend paid for the year, which activity are we talking about? They are saying it's a non-financial company. Okay, even that is also very important. For a non-financial company, dividend payment is because of shares. For financing company, dividend payment might come under operating activity also. Because financing company, the job is to invest, the job is to fund all those things. Okay, so dividend paid for the year is financing activity. TDS on interest income earned on investment made. Since it belongs to investing activity, TDS will also be investing activity. I said all the related activities will be clubbed along with it. Okay. Loans and advances given to suppliers and interest earned from them. Loans and advances given to supplier. Supplier comes in our day-to-day life, they are creditors for us, and any interest earned on them, connected to them. So this is operating activity. Because supplier doesn't come under investing. Supplier is my day-to-day principal business, so therefore it is operating. Deposit with bank for a term of 2 years, investing activity. We made investment. And if it was below 3 months, I would have considered it to be cash equivalent, but it is 2 years, not short term, it's long term, so investing. Highly liquid marketable security without risk of change in value, this is cash equivalent. We have already seen the meaning of cash equivalent, so this will come under cash equivalent. Investment made and dividend earned from them, investing activity. Insurance claim received against loss of stock or loss of profit. This is operating activity, which I agree because stock is working capital. It is operating activity, but it is extraordinary item because there is insurance claim made. So it is operating activity, but it's an extraordinary item. Next, loans and advance given to subsidiary and interest earned from them. Given to subsidiary. When you establish any concern as subsidiary, when you buy shares, when you make investment, so therefore investing activity. Okay, so we got subsidiary because we made investment. For that we are giving loan again, which means investing activity. Issue of bonus share, it is non-cash. It will not come under any activity, it is non-cash. Bonus shares, without collecting cash we are issuing shares. Term loan repaid is financing activity. Then they are asking which activity it belongs to. So let's quickly decide whether whatever we did is correct or not. Financing, correct. Investing, correct. Suppliers is operating as discussed, correct. Deposit for 2 years is investing, correct. Cash equivalent, investing. Insurance claim received is operating as I have told you, but it is extraordinary. Then investing activity, non-cash, so no cash flow, and financing. Okay, so first you should know which activity it belongs to, which we have seen the definition for it. Then automatically how do you apply it in a given scenario. Okay, so I hope whatever questions we have solved till now is understandable for you. Main is theory because we are now revising the stuff. So once you get that theory understanding clearly, you can easily apply on the problems. So I hope that theory was good for you, was understandable, and you can use it in the future. Please give your feedback as to whether all those theory which was given to you worked out or not. Even for other videos also, please give your feedback so that it will be a motivation for us if it is good. If not, even I will try to improve whatever can be done. So give your valuable feedback either through WhatsApp or in the comment section or in the Instagram handle. And please make sure that you go through your studies clearly. It is your studies, you have to do it every day, every time. Give priority to this now because the exams are nearing. Once you cover up as many things as possible, once you cover up most of the elements, then automatically your brain or your mind will be free so that they can recover the other things as well. I hope this video was helpful for you. Please share the video to your friends if you feel it is good enough, if it helps them as well, and make sure that you share and subscribe this video. Okay, so with this, let us end this session of accounting related to cash flow statement. In the future sessions, let us take up some other chapters as well. Some topics of company accounts are remaining, which I will take it up in the coming videos. Okay, so with this, happy studies. Let's meet up again in the next session of accounting revision.